What's up, guys? Welcome back to another day trading video, and today we're going to talk about liquidity. So today we're not going to essentially talk about the mindset more as price action for today. We'll erase that, but it doesn't matter. Today we're going to talk about liquidity, and this is going to help you see price action in a way different stance. All right, you're going to understand what liquidity is and how to use it. And liquidity, in my opinion, is the most essential, not the most, but one of the most essential. Every aspect into whatever you use to catch a trade is very, very important. But this is one of the most important, all right? Because liquidity draws a lot into the market, and I'm gonna go deep into that right now. Okay, so now let's get into deep on understanding liquidity. All right, liquidity is very simple, but also not at the same time. But I'm gonna break it down to you right now. All right, first you have to understand what is liquidity. Liquidity isn't just volume, isn't just a lot of people buying or selling into that trade at that moment. No, 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 no. It's more than that. It's resting orders to be filled. So stop or limit orders, where you're predicting the market to go there and you're putting a stop or limit so it can buy for you instead of just buying openly with the hand movement. So what does that mean? That means liquidity tends to cluster at certain price levels, aka liquidity pools. All right. So a lot of people place their stop or limit orders where they think the price is gonna go, so they put the stop or limit orders at that moment, and that's called liquidity pool because a lot of retail traders place their trades right at that price level. All right. So they make this pool because there's a cluster of that in that area. Then we have the market makers. The market makers need access to those pools to fill in their big orders since they trade with big money. All right, we have retail traders, and then we have institutional traders, traded with the big banks, the big money. That's big, big money. They trade with millions. While we trade with a few thousands or a few hundred thousands, maybe millions, but they trade with billions. All right, so they really are the market makers. They move the market big. All right, so since they have a lot of money coming into these markets, they just can't buy. They have to wait until it gets low, and then they can buy low and bring it up high and sell high. All right, that is their strategy. But how did they bring it? Well, so the market goes to those areas at highs and lows, essentially like a magnet. It's where it brings it in, and boom, it sweeps, drawing liquidity, or we say sweeps. This is the liquidity resting right here from previous low. The market goes up. Now we predict the market to go back down so these big market makers can fill their humongous orders and bring the stock right back up. And that is where we actually buy and gain a profit from their profit as well. So, how do we find these liquidity pools, these resting orders where a lot of traders are leaving their limit and stop orders at that area, where it's very simple? Like we said, they leave it at highs and lows. So we just go into the charts and find highs and lows. It works better on a higher time frame, so we're more able to see it clearly, and it works better on the 1 hour, the 4 hour, and then the daily. And you can try the weekly, maybe even the monthly, sure. But I personally use these three right here, and sometimes even the 15 minute, the 30 minute, but I primarily use it right here. So I will go on my charts, mark out the highs and lows on the 1 hour, the 4 hour, and the daily. Sometimes I just do the 1 hour and the daily, or sometimes the 4 hour and the daily, or sometimes just all three. All right, it's better information given. So you mark out the highs and lows because these highs and lows are magnets right here where stock it wants to go. It wants to bring to this area. It wants to go to this area. Why? Because the big market makers, these market makers with huge amount of money, I'm talking about huge, like I said, billions of money, they want to bring it down. They don't want to buy when it's at the high price. No one wants to buy when it's at the high price. That's why people wait when it's down. So the market makers, they bring the stock down so they can buy, fill in their huge, huge orders just to buy it all the way back up and sell up. All right, these big banks, institutional traders, they are who make the market move, who make these markets go all the way up or all the way down. It works in the complete opposite as well. If the market is all the way up and they want to sell, they bring the stock up, so it's got a high price, and then they sell just to buy it at a low price, gaining that profit from when they sell. All right. So it's very simple to understand. Liquidity in general is just an important concept of trading to learn. Where it's where you can make the money. So when these market makers are bringing that stock up or down, you chase that. You don't chase it. No, no, no. Sorry, correction. You follow that. You follow the trend. All right. So a stock is coming down. I'm gonna draw this right now, right there. All right. So right here we have a bull, and right here we have a bear. So essentially, we have this low right here. That's liquidity, because a lot of retail traders are putting their limit or stop order because they think the market is going to come down, and they get stopped out because they think it's going to continue down, and we're just going to continue on this downtrend. But that's when they get tricked. They don't see the previous low that was right here as liquidity. They don't see it as liquidity. So when they get stopped out, markets go right back up, and that's where the big market makers are cashing the money. And the same thing right here. Retail traders limit stop order, bring a stock up, think it's gonna go up, or they try to ride the big market makers, but they don't see this liquidity. They don't see this as liquidity. They don't see the low. They don't mark it up. They don't. No. So they get stopped out. Big market makers, all right, they bring the stock back down. So when they sell right here at this level and they buy it back, and they make a profit right there. These big market makers, they want these areas to come down to, they want the market to come down to these areas, so the retail traders can get stopped out, and when those, or stopped, or place the limit or whatever, or actually stopped out, when they get stopped out, they'll use those orders of when they got stopped out, so they can use those orders to fill their big ginormous orders, because there's a lot of retail traders. So the big market makers are going to use those retail traders to bring the market in the direction they want, so they can fill their humongous orders. All right, this works for bull and a bearish market. I completely forgot to record my outro, so thank you so much. Thank you so much for watching, guys. If you like it, please like, comment, and subscribe. Share with your friends. Share with everyone. And I'll see you guys in the next video. This is Josh Trade Wars. Peace.